Central banks, they're some of the most powerful and maybe most mysterious institutions on the planet. With just one decision, they can send global markets soaring or tumbling, and it affects all of us. But how? How do they actually do it? Okay, let's dive in and really unpack the playbook they use to steer our economies.
I want you to picture this. It's 2008. The global financial system is in absolute freefall. Panic is everywhere. Then, in December, the U.S. Federal Reserve, America's central bank, makes a move. And we're not talking about just any move. This was a decision so bold it sent total shockwaves through the financial world. The stakes? They literally couldn't have been higher.
So that one moment in that one crisis, it just opens up this huge question, right? What kind of tools do these institutions even have? Are there rules they follow? And how does a decision made in some boardroom end up affecting jobs and prices in the real world? Well, that's exactly what we're going to figure out.
To really get how the system works, we kind of have to start by looking at what happens when it breaks. So our story kicks off right in the heart of that 2008 crisis.
This right here, this was the number that started the frenzy. The Federal Reserve announced it was slashing its main interest rate, the federal funds rate, by 75 basis points, or, 3/4 of a percentage point. This move pushed the rate down to almost zero, as low as it could possibly go.
And let's be totally clear. This was basically the economic version of using a defibrillator. The global economy's heart had all but stopped, and the Fed was trying to shock it back to life. They were knowingly breaking from convention to stop a complete and total collapse. But what convention were they breaking? To get that, we need to look at their standard playbook.
See, in normal times, central banking isn't about these huge, dramatic emergency actions. It's really about following a clear, established strategy. A set of rules designed to keep the economy on an even keel.
Now, at the very heart of this playbook is a concept called the monetary policy curve, or just the MP curve. It's a really simple but incredibly powerful idea. It basically maps out how a central bank should react when inflation changes. It connects the inflation rate to the real interest rate. That's the rate you get after you subtract inflation. And that real rate, well, that's the number that truly impacts whether people and businesses are spending or saving.
And this slide shows that playbook perfectly. Look at point A. When inflation is low, say 1%, the bank keeps the real interest rate pretty low too, at 1.5%. Simple enough. But watch what happens when things start to heat up. At point B, inflation is up to 2%, and boom, the bank has raised the rate to 2%. By the time we hit point C, with 3% inflation, they've tightened the screws even more. It's a super clear, predictable response. As the economy gets hotter, the central bank gently taps the brakes. So why does it slope up like that? Why this specific relationship? Well, it's not random. It's all based on a really crucial economic principle that acts as a kind of North Star for central bankers.
It's called the Taylor Principle, and it's the core logic of the whole playbook. It says that for every 1% that inflation goes up, the central bank has to raise its own interest rate by more than 1%. If they don't, if they just match it, the real interest rate, the one that actually matters, won't go up at all, and they'll lose control of inflation before the fight even starts.
Here's an easy way to think about it. If your car starts speeding up on its own, just taking your foot off the gas might not be enough to slow it down. To really get it under control, you have to hit the brakes, and probably harder than the engine is pushing. The Taylor Principle? That's just the central banker's version of hitting the brakes hard enough to get things back under control.
Okay, so that's all the theory. But what does this actually look like in the messy, complicated real world? Let's check out two really different time periods that show the playbook in action and what happens when they have to throw it right out the window.
This graph shows the U.S. federal funds rate and the inflation rate over time. And you can see two totally different stories here, right? First, there's that pre-crisis period where the two lines are kind of dancing together. And then there's the crisis itself, where that relationship just completely falls apart. Let's look at each one.
So what we're about to see is the huge difference between a standard response and a true emergency shift. A standard response is just a predictable move along that policy curve we've been talking about. But an emergency shift, that's when they basically tear up the old rulebook and move the entire curve itself.
First up, let's look at 2004 to 2006. The economy was doing pretty well, and policymakers started to get a little nervous about inflation picking up. So, what did they do? Exactly what the playbook said to do. They just steadily raised interest rates one step at a time. This was a classic movement along the MP curve. They were just following the rules, moving from a point A to a point B to a point C on that line. Business as usual.
And then the crisis hit, and that old playbook went straight out the window.
The Fed started what's called an autonomous easing, which is a fancy way of saying they decided to ignore the old rules and just slash interest rates like crazy to prevent a total meltdown. They weren't moving along the curve anymore, no, they grabbed the entire curve and just yanked it straight down, signaling a brand new, much more aggressive policy.
So we've seen how central banks make their decisions. But this brings us to the final and honestly the most important piece of the puzzle. How do these decisions actually ripple out and affect the rest of the economy?
I mean, how does some change to the federal funds rate in Washington, D.C. actually impact a small business owner in Ohio or a family trying to buy their first home out in California? Well, it turns out there's a direct, logical chain of events that connects them all.
The whole connection happens in three main steps. We already know step 1, the MP curve links inflation to interest rates. Step 2 introduces something new called the IS curve, which just shows how those interest rates affect the real economy, things like business investment. And finally, when you put those two pieces together, you get the big picture, the aggregate demand curve. Let's walk through it.
Okay, let's break this down. In the top graph, panel A, there's our old friend, the MP curve. Just like before, as inflation rises, the Fed raises the real interest rate. Got it. Now just follow that rate increase down to the middle graph, panel B, which is the IS curve. This shows a really simple truth. As interest rates go up, economic output goes down. It's more expensive to borrow money, so people and companies spend less. See that? We've just connected the dots from inflation to interest rates to the real economy.
And it all comes together right here in this bottom graph, panel C. This is the aggregate demand curve. It pretty much skips the middleman, the interest rates, and connects our starting point, inflation, directly to our endpoint, economic output. By just tracing those points from the top two graphs down, you can see exactly why the AD curve slopes downward. It's the visual proof that the central bank's playbook is working. Higher inflation, in the end, leads to lower economic output.
So here's the bottom line, the most crucial point of all of this. The aggregate demand curve isn't just some abstract graph in a textbook. It shows the entire story. It's the graphical representation of how a central bank's decisions, their entire policy framework, directly influences the health of the whole economy. Which brings us right back to where we started, doesn't it? In 2008, the Federal Reserve had to rip up its own playbook to save the economy. This framework we've just gone through, it's amazing for explaining how things work in normal times, but it also leaves us with a much deeper question for the future. In a world full of surprises and unexpected crises, is having a playbook ever truly enough?